I need to have an honest conversation with you about something that is happening in the AI industry right now. Something that most investors don't want to talk about because they're caught up in the excitement. Something that is going to result in a lot of people losing a lot of money if they're not careful. There are AI companies burning through cash at rates that are simply not sustainable. Companies that are valued at billions of dollars but are hemorrhaging money every quarter. Companies where the path to profitability is unclear at best and impossible at worst. Companies that are going to run into a wall when the funding environment tightens or when investors finally start demanding returns. I've been in the technology industry for decades. I've seen this pattern before. In the late 1990s, companies with no profits and questionable business models commanded enormous valuations because everyone believed the internet would change everything. And the internet did change everything. But most of those companies went bankrupt anyway because having exposure to an important trend isn't the same as having a viable business. The same thing is happening now with AI. AI is going to transform the world. I believe that completely. But believing in AI doesn't mean every AI company is a good investment. Some of these companies are going to fail, and the warning signs are already visible in their financial statements. Today, I am going to warn you about 4 categories of AI companies that are burning cash too fast. I am not going to name specific companies because I don't want to get into legal trouble, but I am going to describe the patterns clearly enough that you can identify them yourself. If you own stocks that fit these descriptions, you need to seriously reconsider your position. Before I get into the 4 categories, let me explain why cash burn matters so much for AI companies specifically. AI companies have enormous capital requirements. Training large language models costs hundreds of millions of dollars in computing. Acquiring and processing training data is expensive. Hiring AI researchers and engineers requires premium compensation. Building the infrastructure to serve AI applications at scale requires massive investment. These costs have to be paid in cash. Unlike some businesses where you can grow profitably from day one, AI companies typically need to invest heavily before they can generate revenue, and the revenue they do generate often doesn't cover the costs for years. This creates a dependence on external financing. AI companies need to keep raising money to fund their operations. They sell equity to venture capitalists and public market investors. They take on debt. They burn through whatever cash they have on hand. As long as investors are enthusiastic about AI, this financing is available. Capital has been flowing into AI companies at unprecedented rates. Valuations have soared as investors compete to own pieces of the AI future. But what happens when investor sentiment shifts? What happens when the next recession hits and risk appetite declines? What happens when a few high-profile AI failures make investors more cautious? Companies that have been relying on continuous financing suddenly can't raise money on attractive terms, or they can't raise money at all. Their cash runway shortens. They have to cut costs dramatically, which impairs their competitive position. Some of them fail entirely. This is the scenario I am worried about. Not because AI is going to disappoint, but because many AI companies have built business models that depend on perpetual financing rather than sustainable economics. When the music stops, they'll be caught without a chair. Let me tell you about the first category of AI companies burning cash too fast. These are the AI application companies with no differentiation. The AI gold rush has spawned thousands of companies building applications on top of foundation models. They take a large language model from OpenAI or Anthropic or an open source alternative, wrap a user interface around it, add some prompting, and call it a product. Some of these applications are genuinely useful: writing assistants, coding helpers, customer service bots, image generators. There is real demand for these tools. Some companies are generating real revenue. But here's the problem: the differentiation is minimal. If your product is basically a wrapper around someone else's AI model, what prevents competitors from building the same thing? What prevents the model provider from offering the same functionality directly? What prevents customers from just using the underlying model themselves? The answer is usually not much. These companies are competing primarily on marketing and user experience, not on fundamental technology. Their moats are shallow, their competitive advantages are temporary, and while they're fighting for market share with minimal differentiation, they're burning enormous amounts of cash. They're spending on marketing to acquire customers, they're paying substantial fees to the model providers whose APIs they depend on, they're hiring engineers to keep improving their applications, they're investing in infrastructure to serve their users. The unit economics often don't work. The cost to acquire a customer exceeds the lifetime value of that customer. Every new user actually increases losses. Growth makes the problem worse, not better. I've looked at the financials of companies in this category. I've seen companies losing 50 cents or more on every dollar of revenue. I've seen customer acquisition costs that would take years to recover even if customers stayed forever, which they don't. I've seen cash burn rates that give them 18 months of runway, maybe less. These companies are betting that they can grow fast enough to achieve scale advantages, that they can raise more money before the current funding runs out, that something will change to make the economics work. Sometimes those bets pay off, more often they don't. If you own stock in an AI application company, look carefully at their differentiation. Are they doing something that is genuinely hard to replicate, or are they just executing faster than competitors who could catch up at any moment? Look at their unit economics. Are they profitable on a per customer basis, or are they subsidizing growth with investor cash? Look at their cash position. How long can they operate at the current burn rate? The second category of AI companies burning cash too fast are the AI infrastructure companies building commodity services. There is a layer of infrastructure between the foundation models and the end. User applications, companies providing model hosting, companies providing vector databases, companies providing AI development tools, companies providing monitoring and observability for AI systems. Some of these infrastructure companies are building genuinely differentiated technology. They have architectural innovations or proprietary data or network effects that create competitive advantages. These companies might be good investments even if they're currently burning cash. But many of them are building commodity services. They're providing functionality that is relatively easy to replicate. They're competing primarily on price, which compresses margins. They're trying to grow into massive markets before competitors or cloud providers take over. The cloud provider threat is particularly acute. Amazon, Microsoft, and Google all have AI platforms. They're all adding infrastructure services that compete with standalone providers. When a cloud provider offers comparable functionality integrated with their existing platform, standalone providers face a serious challenge. I've seen this pattern play out in cloud infrastructure before. Startups would identify a useful service, build a company around it, and start generating traction. Then Amazon Web Services would launch a competing service integrated with their platform and offered at scale pricing. The startups would struggle to compete. The same dynamic is playing out in AI infrastructure. Standalone vector database companies are competing with vector capabilities built into cloud databases. Standalone model hosting companies are competing with cloud AI platforms. The differentiation that seemed meaningful early on becomes less meaningful as the big platforms catch up. Meanwhile, these infrastructure companies are burning substantial cash. They're investing in engineering to build and improve their platforms. They're spending on sales and marketing to acquire customers. They're offering discounts and free tiers to compete for market share. The losses are significant. The companies that will survive are those with genuine differentiation that the cloud providers can't easily replicate. Maybe they have proprietary technology that is years ahead. Maybe they have specialized focus on a vertical where general purpose platforms fall short. Maybe they have open source communities that create switching costs. But many AI infrastructure companies don't have these advantages. They're racing to build scale before the cloud providers catch up, hoping that scale will create its own advantages. This is a risky bet that often doesn't pay off. If you own stock in an AI infrastructure company, assess the competitive threat from cloud providers. So to service that AWS or Azure or Google Cloud could easily offer. Are they already offering something similar? How would the company differentiate if the cloud providers entered aggressively? The third category of AI companies burning cash too fast are the AI hardware startups challenging established players. The success of AI has created enormous demand for specialized hardware. The chips that power AI training and inference are extremely valuable. The leading chip provider has seen their stocks soar as customers scramble for computing capacity. This success has attracted numerous startups attempting to build alternative AI chips. They promise better performance, lower power consumption, better price-performance ratios. They raise hundreds of millions or billions of dollars. They hire talented engineers, they tape out chips and bring them to market. But building competitive AI chips is extraordinarily difficult. The established players have years of head start. They have mature software ecosystems that make their chips easy to use. They have manufacturing relationships that ensure supply. They have customer relationships built over many design cycles. The startups face daunting challenges. Their chips might benchmark well on specific tasks, but struggle with the broad range of workloads customers need. Their software stacks are immature compared to the incumbents. They face the chicken and egg problem where customers won't adopt until the software is ready, but engineers won't optimize software until customers adopt. And all the while, they're burning enormous amounts of cash. Chip development is expensive. A single tape out can cost hundreds of millions of dollars. Building a software team to create the development tools and libraries takes years and significant investment. Hiring engineers away from established players requires premium compensation. Some of these startups will succeed. Competition is healthy for the industry, and the market is large enough for multiple players. But many will fail. Their chips won't deliver on the promise. Their software won't reach maturity. Their customers will remain with established suppliers who reduce risk. The warning signs are visible. Companies that have been shipping chips for years but haven't achieved meaningful market share. Companies that keep pushing back timelines for product launches. Companies where key engineers and executives are leaving. Companies that need to raise another round of funding just to keep the lights on. If you own stock in an AI chip startup, be honest about their competitive position. Are they actually winning customers away from established players? Is their software ecosystem reaching critical mass? Do they have the financial resources to sustain the fight for the years it will take to establish a real position? The fourth category of AI companies burning cash too fast are the AI research labs trying to build artificial general intelligence. This is perhaps the most speculative category and the one where the cash burn relative to near-term revenue opportunity is most extreme. Several companies are explicitly pursuing artificial general intelligence, AI systems that can match or exceed human cognitive capabilities across a wide range of tasks. This is an ambitious goal that could be transformative for humanity if achieved, but it is also a goal that might be decades away or might prove impossible with current approaches. These companies are raising billions of dollars to fund research. They're hiring the best AI researchers at enormous salaries. They're building massive computing infrastructure for training ever larger models. They're operating with minimal revenue because their products are still in development or being given away to build user bases. The cash burn is staggering. Some of these companies are losing billions of dollars per year. Their computing costs alone exceed the entire budgets of most technology companies. They're betting that achieving AGI will be so valuable that current losses are irrelevant. Maybe they're right. If AGI is achieved, the value created could dwarf any historical precedent. The companies that achieve it first could become the most valuable entities in human history. The current losses would be rounding errors, but the risks are enormous. The path to AGI is unclear, the timelines are uncertain, The resources required might be beyond what any company can sustain. The regulatory and safety concerns might limit deployment even if the technology works. And there are competitive dynamics to consider. Multiple companies are pursuing AGI. They can't all win. Some will achieve breakthroughs while others hit dead ends. Predicting which requires understanding of technical trajectories that even experts struggle with. The funding requirements create pressure. These companies need to keep raising capital to sustain their research programs. As long as investors are enthusiastic, capital flows in. But investor sentiment can shift quickly. A few disappointing results, a few missed milestones, and suddenly the billions of dollars needed are harder to raise. If you are invested in AGI-focused companies, understand what you are betting on. This isn't a bet on AI applications generating revenue next year. This is a bet on achieving one of the most ambitious goals in the history of technology on a timeline that is inherently uncertain. The potential rewards are enormous, but so are the risks of total loss. Let me talk about the broader pattern that connects these four categories, because understanding the pattern helps you evaluate any AI company. The companies burning cash unsustainably share certain characteristics. They're investing heavily in growth before establishing profitable unit economics. They're competing in markets where differentiation is difficult. They're depending on continuous access to external financing. They're betting that scale will solve problems that fundamentals can't. The companies that will thrive have different characteristics. They have genuine competitive advantages that protect them from commoditization. They have unit economics that work, with each additional customer contributing to profitability. They have business models that generate cash rather than consuming it. They're building sustainable businesses, not just grabbing market share. This distinction matters more as interest rates have normalized and capital has become more expensive. During the era of zero interest rates, investors tolerated enormous cash burn because the opportunity cost of capital was minimal. Patient capital would wait years for profitability. That environment has changed. Interest rates are meaningful. Alternative investments offer real returns. Investors are less willing to fund years of losses. The bar for continued financing has risen. The companies that built their strategies around cheap capital are now vulnerable. The companies that always focused on sustainable economics are better positioned. The reckoning that should have happened years ago is finally arriving. Let me share some specific warning signs to look for in AI company financials. First, look at the gross margin trend. Companies with improving gross margins are often achieving scale benefits or pricing power. Companies with declining gross margins are often facing competitive pressure or increasing costs. AI companies with negative or deeply negative gross margins have fundamental problems with their business models. Second, look at the operating expense growth relative to revenue growth. Healthy companies see operating leverage, where expenses grow more slowly than revenue as they scale. Unhealthy companies see the opposite, where expenses grow faster than revenue because customer acquisition is getting harder, or because they're investing desperately to keep up with competitors. Third, look at the cash burn rate relative to cash on hand. Divide the current cash position by the quarterly cash burn to get runway in quarters. If a company has less than 2 years of runway and isn't profitable, they'll need to raise more money. Consider what that fundraising might look like given current market conditions. Fourth, look at customer metrics beyond revenue. Customer acquisition cost, customer lifetime value, net revenue retention, churn rates. These metrics reveal whether the company is building a sustainable customer base or just buying growth with investor money. Fifth, look at what management says about the path to profitability. Do they have a clear plan with specific milestones, or are they vague about when losses will end? Do they talk about unit economics improving, or do they just talk about growth? Let me discuss what happens when cash-burning AI companies hit the wall. The first stage is usually a down round. The company needs money but can't raise at their previous valuation. They accept dilutive terms that transfer value from existing shareholders to new investors. If you own shares from before the down round, your ownership percentage shrinks and the value of your shares declines. The second stage might be cost. Cutting the company slashes headcount, reduces spending on everything non-essential, and tries to extend their runway. This often damages their competitive position. The best employees leave for more stable companies. Product development slows. The death spiral begins. The third stage could be a distressed sale. A larger company acquires them at a fraction of their peak valuation. Shareholders get cents on the dollar. The technology lives on, but the investment thesis fails. The fourth stage, for some companies, is bankruptcy. They can't find a buyer. They can't raise money. They run out of cash and shut down. Shareholders get nothing. I've seen all of these outcomes play out in previous technology cycles. Companies that seemed unstartable became cautionary tales. Investors who thought they were getting in early on the next big thing lost everything. I don't want that to happen to you. That is why I am sharing this warning. Let me be clear about what I am not saying. I am not saying AI is a bubble that is going to pop. AI is real and transformative. I am not saying all AI companies are bad investments. Some are building incredible businesses. I am not saying you should avoid AI entirely. You should probably have AI exposure in your portfolio. What I am saying is that you need to be selective. You need to distinguish between AI companies with sustainable business models and AI companies that are burning cash unsustainably. You need to look at the financials, not just the narrative. You need to be willing to sell when the warning signs appear, even if you are excited about the technology. The AI revolution will create enormous wealth, but it will also destroy wealth for investors who bet on the wrong companies. The difference between the winners and losers often comes down to business fundamentals that are visible in the financial statements. If you are willing to look, let me close with some specific advice for evaluating your AI holdings. Pull up the financial statements for every AI company you own. Look at the trends in revenue, gross margin, operating expenses, and cash flow. Calculate the runway. Assess the competitive position. Ask whether this company can get to profitability before running out of money or needing to raise at dilutive terms. If the answer is unclear, that is a warning sign. If the answer is clearly no, consider selling. The excitement about AI doesn't change the mathematics of cash burn. Compare the company to profitable AI businesses. Companies do exist that are generating cash while participating in the AI revolution. They have business models that work. They have competitive advantages that protect their margins. They're investing in growth, but from a position of strength rather than desperation. Consider whether you are being compensated for the risk. High-risk investments should offer high potential returns, but many cash-burning AI companies are already priced as if they've succeeded. The upside is limited, while the downside is total loss. That is not an attractive risk-reward. Diversify your AI exposure. Rather than betting on individual companies, consider spreading your exposure across multiple plays. Index funds that include AI exposure establish technology companies that are benefiting from AI, infrastructure providers that sell to all AI companies regardless of which ones win. Be patient, but not stubborn. It is okay to hold volatile positions if you believe in the long-term thesis and the fundamentals support it. But don't confuse patience with stubbornness. If the fundamentals deteriorate, if the competitive position weakens, if the runway shortens, be willing to cut your losses. The AI revolution is going to be incredible. It is going to transform industries, create new possibilities, and generate enormous wealth. But not every company participating in that revolution will succeed. The ones burning cash too fast are at particular risk. I've given you the framework to identify them. Application companies with no differentiation, infrastructure companies building commodity services, hardware startups challenging entrenched incumbents, research labs pursuing distant goals with near-term cash needs. Look at your portfolio. Look at the financials. Be honest about what you see. And if you are holding companies that fit these patterns, consider whether that is really where you want your money to be. The warning signs are there. The question is whether you'll heed them before it is too late. Let me go deeper on each of these 4 categories because I want you to understand exactly what to look for in your own portfolio. Starting with the AI application companies, let me explain why the lack of differentiation is so deadly. In traditional software, companies could build moats through switching costs, data network effects, and integration complexity. Once a customer adopted your software, they were unlikely to switch, because the cost of switching exceeded the benefit. AI applications often lack these moats. The underlying intelligence comes from foundation models that anyone can access. The user data might improve the application, but it is often not proprietary in ways that matter. The integrations are often simple API connections that competitors can replicate. I've watched this play out in real time. A company builds an AI writing assistant that generates good marketing copy. They acquire customers, grow revenue, generate excitement. Then a competitor launches a nearly identical product at a lower price. Then the foundation model provider releases their own writing tool. Within 18 months, the original company's growth has stalled and they're fighting for survival in a commoditized market. The cash burn during the growth phase looked justified because revenue was growing. But the revenue growth masked the fundamental problem. There was no defensible position. When competition arrived, margins collapsed, and the economics fell apart. Look at any AI application company in your portfolio and ask these questions: what would prevent a well-funded competitor from replicating this product in 6 months? What would prevent the foundation model provider from offering this capability directly? What would keep customers from switching? If a cheaper alternative emerged, if you can't articulate clear answers, the company probably doesn't have answers either. They're hoping that brand recognition or speed will be enough. Sometimes it is, more often it isn't. The API cost structure deserves special attention. Many AI applications pay per token or per query fees to the foundation model providers. This creates a cost structure where gross margins are capped by API costs, and those costs might not decline as fast as pricing pressure increases. I've seen companies with gross margins of 30 or 40% that look reasonable. But when you dig in, you realize the API costs are eating most of the revenue. There is no leverage in the business model. Even at scale, they'll struggle to achieve the 60 or 70% gross margins that healthy software companies enjoy. Let me expand on the AI infrastructure category because this is where I see some of the most misleading metrics. AI infrastructure companies often point to impressive growth rates. Revenue doubled last year. Customer count tripled. Usage is exploding. These metrics look great in a pitch deck or an earnings release, but growth rates don't tell you about sustainability. A company could be growing 100% year over year while losing money on every customer. The growth could be fueled entirely by discounting and promotions. The customers could be using free tiers with no path to conversion. Net revenue retention is a metric that AI infrastructure companies love to cite. They'll say their net revenue retention is 130%, meaning existing customers are spending 30% more each year. This sounds like strong product market fit. But dig into how they're achieving that expansion. Is it because customers love the product and are using it for more workloads? Or is it because prices are increasing and customers are stuck because switching is painful? Or is it because the denominator is shrinking as smaller customers churn and only the big customers remain? The competition from cloud providers is existential for many AI infrastructure companies. When AWS or Azure or Google Cloud decides to offer a service, they have structural advantages that are nearly impossible to overcome. First, they have the customer relationship. Enterprises already use cloud services. Adding another service from the same provider is frictionless. Using a third-party vendor requires new contracts, new security reviews, new integration work. Second, they have integration advantages. Cloud provider services work seamlessly together. Third-party services require additional configuration and maintenance. The total cost of ownership favors the integrated solution. Third, they have pricing power. Cloud providers can afford to underprice new services because they're strategic complements to their core business. Standalone providers have to charge enough to survive as independent businesses. I've watched cloud providers systematically absorb functionality that was initially provided by startups: container orchestration, message queuing, database management, service mesh. Each time, the standalone providers lost market share to the integrated cloud offering. The same pattern is emerging in AI infrastructure. Vector databases, model serving, MLOps tools, AI monitoring. These are all categories where cloud providers are expanding their offerings. The standalone providers need to run faster just to stay in place. Let me go deeper on the AI chip startups, because this category illustrates the challenge of competing against entrenched incumbents. Building a competitive AI chip requires excellence across multiple dimensions simultaneously. The chip architecture has to be efficient for AI workloads. The manufacturing process has to deliver competitive performance and yields. The software stack has to make the chip easy to program. The developer ecosystem has to provide the tools and libraries that customers expect. Excelling at one dimension isn't enough. A chip with great architecture but immature software will struggle to win customers. A chip with great software but manufacturing problems will be delayed until the market moves on. Everything has to come together simultaneously. The incumbent has spent over a decade building their position. Their software ecosystem includes libraries optimized for every major AI framework. Their tools support the workflows that researchers and engineers have standardized on. Their chips are manufactured on leading-edge processes with years of yield optimization. A startup has to match or exceed all of this while operating with a fraction of the resources. They have to hire engineers away from the incumbent or from the limited pool of chip designers globally. They have to build software teams that can cover the breadth of use cases customers need. They have to secure manufacturing capacity from foundries that are already capacity constrained. The funding requirements are staggering. A single chip tape out can cost over $100 million. Building a software team might cost $50 million per year. Supporting customers requires applications, engineers, and technical support. The burn rate for a serious AI chip effort is measured in hundreds of millions annually. Some startups have raised enough money to sustain this burn for several years, but the market is brutally competitive. If a chip doesn't achieve commercial success within a few product cycles, the company runs out of runway. The investors lose patience. The best engineers leave for more promising opportunities. The companies that might succeed are those with genuine architectural innovations that deliver performance the incumbent can't match. Maybe they've found a different approach to memory bandwidth. Maybe they've discovered more efficient ways to handle sparse computations. Maybe they're targeting specific workloads where general-purpose chips are inefficient. But even with innovations, they face the software challenge. Customers won't adopt chips that require rewriting their code. The software ecosystem has to be compatible enough that migration is easy while also unlocking the architectural advantages. I've seen multiple AI chip startups go through the cycle of hype, disappointment, and decline. Their benchmarks looked impressive, their pitch decks were compelling, their initial customer pilots were promising. But the transition from pilots to production deployments never happened at scale. Let me expand on the AGI. Focused research labs, because this is where the cash burn is most extreme and the outcomes most uncertain. The race to AGI has attracted some of the largest investments in the history of technology. Companies have raised tens of billions of dollars. Computing infrastructure worth billions has been deployed. Thousands of the world's best AI researchers have been assembled. The scale of ambition is breathtaking. These companies believe they're working on the most important technology in human history. They believe success would be so transformative that current losses are irrelevant. They operate with urgency because they believe other labs might achieve AGI first. This mindset drives enormous spending. Why optimize costs when the goal is so important and the timeline is so urgent? Why worry about profitability when achieving AGI would generate unlimited value? The logic makes sense internally, but it creates massive cash burn externally. The computing costs alone are staggering. Training frontier models requires thousands of high-end chips running for months. A single training run might cost $50 or $100 million. And these companies don't do one training run. They do many, experimenting with different approaches and architectures. The talent costs are equally significant. The best AI researchers can command salaries measured in millions of dollars. Competition for top talent is fierce, driving compensation ever higher. A team of 100 elite researchers might cost over $100 million per year. The infrastructure costs continue after training. Serving AI models to users requires substantial computing capacity. As usage grows, infrastructure costs scale proportionally. The operating costs compound on top of the development costs. Some of these companies are generating revenue by offering access to their models, but the revenue often doesn't cover the costs. They're subsidizing usage to build market share, hoping that future pricing power will generate returns. The competitive dynamics add pressure. Multiple well-funded labs are racing towards similar goals. Each lab feels compelled to match the other's investments. Falling behind in the race might mean losing relevance entirely. This competition drives spending higher across the industry. The timeline uncertainty is profound. When will AGI be achieved? Predictions range from a few years to a few decades to never. The researchers themselves disagree about what is possible and when. Investing in AGI-focused companies requires accepting this fundamental uncertainty about timelines. Let me talk about how market conditions affect all of these cash-burning companies. During the era of low interest rates, capital was abundant and patient. Investors were willing to fund years of losses in pursuit of long-term opportunities. Unprofitable companies could raise at increasing valuations as long as the narrative remained compelling. That environment has changed. Interest rates have normalized, making alternative investments more attractive. Risk appetite has declined as some high-profile technology investments have disappointed. The bar for new funding has risen. Companies that built their strategies around easy capital access are now vulnerable. They expected to raise another round before running out of cash. They expected valuations to keep rising. They expected investors to remain patient through extended periods of losses. Some of these expectations are no longer valid. Funding rounds are harder to complete. Valuations are under pressure. Investors are demanding clearer paths to profitability. The music has slowed, and some companies will find they don't have chairs. The consequences will unfold over the next few years. Companies with adequate runway will have time to adjust. Companies with short runway will face immediate pressure, down rounds, cost cuts, distressed sales, and failures will become more common. This is why evaluating cash burn matters so much right now. The companies that are burning sustainably, that have long runway, that have paths to profitability, will navigate this environment successfully. The companies that are burning unsustainably will struggle. Let me close with some thoughts on how to position your portfolio given these dynamics. First, bias toward profitability. All else equal, profitable AI companies are safer than unprofitable ones. They're not dependent on continued access to external capital. They can invest from strength rather than desperation. They've proven that their business models work. Second, bias toward differentiation. Companies with genuine competitive advantages, proprietary technology, network effects, switching costs, can sustain their positions through difficult periods. Companies competing primarily on execution in commoditized markets are vulnerable. Third, bias toward established players. Large technology companies with AI exposure have the resources to invest through any environment. They don't face the funding pressures that challenge startups. Their AI businesses might be smaller portions of their overall business, but they're more resilient. Fourth, be willing to sell. If you own AI companies that fit the warning patterns I've described, don't wait for confirmation. The time to sell is before everyone else realizes there is a problem. By the time the issues are obvious, the stock will have already declined substantially. Fifth, diversify your AI exposure rather than concentrated bets on individual companies. Spread your exposure across multiple players. If some fail, others might succeed. Portfolio diversification reduces the impact of any single company's failure. The AI revolution is real and transformative, but not every company will survive to benefit from it. The ones burning cash too fast are at particular risk. I've shown you the patterns to look for and the questions to ask. Your portfolio is your responsibility. Evaluate it honestly. Make the changes you need to make. And don't let excitement about AI blind you to the fundamental economics of the companies you own. The reckoning is coming for cash, burning AI companies. Make sure you are positioned on the right side of it.